If you have been on YouTube lately, it probably feels like the housing market is going to crash any minute now. You have scary headlines, arrows, red arrows everywhere, a collapse, a meltdown coming. So today, instead of guessing and panicking, I want to slow things down with you and look at the data so you see what I see. We're going to look at what causes housing crashes, what role the Fed really plays, and whether 2026 actually fits that pattern or if all of this is just noise. Okay, side note. I know what I'm about to say might get a lot of people in my industry very upset at me, and some of those YouTube experts out there also extremely concerned. However, they are not my audience. You are. And the reality is that I have over 18 years selling real estate. That's over 20 plus homes per year, equaling out to $125 plus million sold of real estate. That kind of experience gives me somewhat of an expertise in my field and something that some people might call a master's degree in my field. I am not a content creator and definitely not a social media guru or influencer. I'm an actual real estate agent who owns his own real estate team, and my job is to be in the trenches helping everyday people like you. So, having said that, let's cut through all the clickbait and get to the truth and bottom line of things. So let's slow things down and get this video started. So let's go over why these videos are blowing up. Fear travels faster than facts, and especially in uncertain markets. Right now, we have high prices and high rates, and affordability for families is almost stretched to the limit. The Fed, or Federal Reserve, estimates the U.S. median house price was $410,000 in Q4 of 2025. This means that a household income of at least $81,000 is needed to purchase this home with a 20% down payment. And the average household income in 2024 was $83,000. That's a $2,000 difference in affordability. This creates anxiety, and anxiety creates clicks. But high views don't always mean high accuracy. So before we talk about 2026, we need to talk about what actually causes housing crashes. Housing crashes don't happen just because, prices are high. They happen when large numbers of people are forced to sell. That usually comes from job losses, bad loans, or debt structures that collapse under pressure. So remember, from 2002 to 2007, we had a massive spike of delinquencies because of deregulation of loan applications. That allowed borrowers to qualify for homes with risky loans, which in 2008, homeowners could not afford the monthly payment after those variable rates adjusted to their higher rate. This gave rise to the highest delinquency ever seen in mortgages, when in 2010, we hit a high of almost 12% in delinquencies nationwide. In 2008, it wasn't just prices. It was adjustable loans, no doc mortgages, and massive over-leveraging. Without forced sellers, prices don't crash, they don't stall, they soften, and they move sideways. This is where we are today. Look, a lot of people think that rate cuts automatically fix housing affordability. But here's the truth. The rate cuts don't make houses cheaper overnight. We know this because we have seen it in the past couple of years when the feds have cut rates from early 2023 till today. And housing values have either decreased slightly in places like Orange County or remained steady in places like Los Angeles or Philadelphia, or even decrease in some markets like Nevada and Arizona. And then you have other bigger markets like Florida and Texas where they have seen a big decrease in prices. Small rate cuts usually bring buyers back faster than they bring massive price cuts. That's why in some markets, we often see competition increase before affordability improves. Rates are just one piece of the housing puzzle. Now, supply, wages, and demand matter just as much. When we compare today to past crashes, some things look very similar, but the fundamentals are very different. Lending standards are tighter today, homeowners have more equity, and supply is still constrained in many markets. Please take notes. Watch this. There are some markets that have more supply than demand, like Texas, Idaho, and Florida, where new construction developers built a high amount of homes because of the huge increase in migration they received post-2020. And now, with high rates, their markets have slowed down significantly. But this is not the case everywhere. This is very localized to specific areas. This is where you see most of those clickbait videos coming from. That doesn't mean prices can't adjust. It means crashes follow rules. And not every cycle ends the same way. Look, side notes. The variables that actually cause crashes are wars, pandemics, a financial or economic collapse, or a natural disaster. And these items we cannot factor in because we have no way of actually and accurately predicting them. If you're a buyer, seller, or investor, these are the indicators you should actually be looking for. Massive layoffs or high unemployment numbers, which we do have today. A high amount of distressed property inventory. We do not have that right now. New construction prices and incentives on the rise, which we do have, but in very specific markets. Again, Texas, Idaho, Florida, and Arizona. Credit tightening, which we do not have, and rental demand, a high rental demand, which we only have in very specific cases. So watch for the indicators, not headlines. So in conclusion, the people who have always won in real estate aren't the ones predicting crashes. They are the ones who understand cycles. And 2026 isn't about fear, it's about strategy. And if you want clear and honest breakdowns like this, without the fear tactics or clickbait, make sure to subscribe.